In today's video, we're going to be covering the top 10 questions that we get from CPAs, accountants, attorneys, advisors, forward-thinking YouTubers just like yourself that have seen our videos that talk about how if you make $1 million of monies, whether it's W-2 income or if you're converting a large multi-million dollar Roth IRA conversion, and you've got a tax bill of $400,000, how is it that we can reduce that tax liability down to zero? How do we do that legally? Where are the tax court cases that this definition is based on? We're going to cover that in today's video of things that you can use right now to reduce your tax liability. Let's get into it. All right, here we are. Question number one, how can I reduce my taxes on W-2 income and Roth conversion income? Well, primarily from a high level, you can use deductions in the tax code. You've got your personal deductions that are filed on your itemized tax return. And unless you don't have over $30,000 of those, if you're a married couple filing jointly, it's not going to be of much worth to you. But you can also use business deductions. Don't worry, if you don't have a business, we can show you how to start one and legally use some of these deductions. Our favorite right here is the depreciation deduction under Section 179. This allows you to deduct up to $1.2 million of both business income and or W-2 income and or Roth conversion income. So Section 179 is part of the Internal Revenue Code. It's been around for years. The IRS actually has a paper on this where they give the definition, and it says that Section 179 allows business owners to deduct the cost of certain property as an expense against their income. The deduction applies to tangible property, business equipment used in a trade or business, and certain properties used to furnish lodging. The type of equipment that we want to purchase for our business will be used in lodging. So this is not only going to make you money by reducing your taxes, but it's also going to make you money by creating an income for you. Section 179 deductions can be used to offset your income dollar for dollar, again, up to that $1.2 million limit. What qualifies as Section 179 property? An easier definition is Form 4562 of the IRS. It says that it's certain types of real property, like a roof on your business, or tangible personal property. In this case, there's certain types of property that's used to furnish for lodging or in the connection with the furnishing of lodging, i.e. transient housing. That's what we want to focus on. My favorite Section 179 asset that I like to use to reduce the taxable income of folks that are making over $1 million and to take that tax liability down to zero are tiny homes, certain types of tiny homes that qualify as Section 179 assets under the code. Now, I've got a white paper that you can download that goes through the details of Section 179 of what the definition of these assets are, what the application is, and what the case law is based on. But essentially, the tiny home is not viewed as real estate. It's viewed as business equipment because the functional use of that tiny home is being used to provide lodging for individuals that are transient for 30 days or less. So there's 4 different case laws in the tax code that carve out this exception, again, for these types of assets to qualify for the full Section 179 deduction. The case laws, we have Evans versus the Commissioner. This is a case where there's a general contractor out of Boise, Idaho. His son was racing motocross, and his dad went out and bought an RV unit and a trailer to sponsor his son, and he claimed a deduction for the full amount. The IRS came in and they disallowed that deduction, so he took him to court. And in court, the judge reversed the IRS's administrative decision, stating that the individual could deduct the full amount of the recreational trailer because the functional use of the trailer was to provide for lodging. It was used for transportation and transient lodging. So the functional use applied. There's another case in 1972. This is known as Moore versus the Commissioner. Here, this individual Moore was renting mobile homes to tenants, some for a period of 10 weeks and some for a period of 2 weeks. He was claiming the Section 179 deduction for the cost of these mobile homes because he was providing it to transient workers. Well, the IRS came in and looked at this they allowed the full deduction for those that were using the average stay was 30 days or less for the 1.7 weeks, and they disallowed the deduction for those that were staying for longer than that time period. In this case, it was 9.9 weeks. The question they had the court is, when a vehicle is used for both lodging and transportation, which one is the primary use? And in this case, again, they focused on the functional use of the asset. A third case in 2004 is Shirley versus the commissioner. In this case, Shirley owned a bunch of different motorhomes, and they rented these out to individuals. And the particular motorhome in question was a 1998 Gulfstream RV. The IRS said that they could not expense it as a deduction because its primary use was for transportation. So Shirley took the IRS to court and said that the primary use of the unit was for lodging. They showed the hours that they had been tracking for these units, and primarily the majority of the time, the usage was for lodging. Therefore, it qualified for the exception to the exclusion because lodging is used by the transient, i.e. short-term rentals. They argued in one that their RV rental deduction should count. And the court said, quote, "We conclude that motorhomes, like Shirley's, used by renters, mostly for periods of less than 30 days, are Section 179 property." So those are three solid court cases that you can reference that is based on this language that if you're purchasing a Section 179 asset and it's used primarily for lodging for transient workers for 30 days or less, you've got yourself a full Section 179 deduction. Question number 6. What is the amount of the deduction that I can get from my Section 179 purchase, and how much will I save in taxes? Well, the amount of the deduction that you'll get is based primarily on the purchase price of your unit. So I've got some hyperlinks here that talk about Section 179A, where it defines the cost of your unit is what you can use as the deduction. The IRS has the basis of the asset. It says it's the cost of the amount that you pay in cash, debt obligations, and other property services. Therefore, you can finance the cost of this tiny home, and your entire financed amount will count as an itemized deduction. In this example, someone purchases the asset for $375,000. That's the amount of the deduction that they're going to receive. So if you have $375,000 of taxable income, your taxable income goes down to zero with one tiny home purchase. $275,000 is financed at 0% for 360 months, and that gives you a monthly payment of $763 a month. Now, the company is offering in-house financing on this deal, so there's no credit checks or requirements or things like that, because the company is having you sign an equipment purchase agreement, and they're placing a lien on the equipment itself, on the tiny home itself. So they've got a lien on it. And on the same day that you purchase the equipment, you're entering into a lease contract where a third party is leasing the tiny home from you, and they're paying you $880 a month. So your cost is $760 a month, and this unit is getting leased out from you at $880 a month. So you're profiting $100, $120 a month. For every tiny home that you buy, you've got a $375,000 reduction in income. And if you're in the 40% bracket, you're roughly going to save about anywhere from $140,000 to $145,000 for every tiny home that you purchase. So if you've got $1 million of income, $1.2 million of income, the math really is that simple. You can buy 3 of these tiny homes, and that wipes out your income completely. It takes it down to zero. If you do $1 million Roth conversion, and instead of paying $400,000 in taxes, you can pay a couple $100,000 in the tiny home purchases, get them financed, and again, use this third party to pay for the cost of your loan every month for the next 30 months. How many units can I purchase? I covered that. You can purchase up to the maximum. Well, you can purchase more than that and just use it as an investment. But as far as the deduction goes, it's 1.2 million. Where in the tax code does it say that I can use a Section 179 expense to offset my W-2 income? Well, on Form 4568, line 11, on the instructions for Form 4568, line 11, this is the depreciation and amortization form. It says, quote, the total cost you can deduct, right? Using Section 179 is limited to your taxable income from your active conduct of a trade or business during the year you are considered to be actively conducting that trade or business, only if you meaningfully participate in its management. And then it gives us a definition for individuals, and it says the total taxable income from any trade or business that you have actively conducted also include all wages, salaries, tips, and other compensation you earned as an employee. So where in the tax code does it say that you can deduct W-2 income? If you got $1 million of income, 3 of these units, you were going to pay $400,000 in taxes. The purchase of these 3 units wipes out your income and you pay 0 in taxes. That is found on the instructions to Form 4568. This is the amortization and depreciation form. It gives a definition under the individual section. It says, enter as income the taxable income from any trade or business that you have conducted. Also include all wages, salaries, tips, and other compensation you earned as an employee from Form 1040, line 1, i.e., your W-2 income. There's a tax court case that backs this up as well. This is Bloomberg versus the commissioner. It's 40 years old. Essentially, in this tax court case, it said that the tax court case that backs this up as well, Bloomberg versus the commissioner in 1980, it treats the employee as being in the business of being an employee. Number 9, how is the financing handled? I covered this a little bit before in the previous question, but it's a $375,000 purchase price. That's what you're using. The full cost of that is what you're using to offset your income. It's a $100,000 down payment. $275,000 is financed each month for 360 months. You sign a security agreement where your unit is used as collateral. It's a recourse loan, and there's no personal guarantee. Question number 10, how do I make money on the purchase of my Section 179 tiny home? Well, the most logical way to do it is you can rent it out for monthly income. You hire a third-party company to go out and rent this unit for you. As a matter of fact, on the day of closing, if you choose, you can enter into a 30-year lease agreement. So you buy your box house, you put $100,000 down, and the company is going to finance that box house for you over the next 360 months at $760 a month. You enter into a third-party lease agreement for a company that's going to pay you $780 a month every month for the next 30 years for the right to use your unit. They are going to pay for the transportation costs and setting up your unit. They're going to furnish your unit. They're going to rent it out. They're going to pay for any of the repairs and the damages. And they actually have a right to purchase the unit at the end of the 30-year term if they want to. The point being is you've got this non-cancelable lease that's in place. If you find a better leasing arrangement, you can cancel that lease and go with another provider. But essentially, it's a way you can get into this and have a third party manage that moving forward. Last question we have is, if this sounds too good to be true, what's the catch? The idea that you can use a Section 179 asset to reduce your W-2 income if you have income of over $1 million, or if you've got Roth conversion income over $1 million, is not too good to be true. It's been in the code for years. So that's how you can use Section 179, a properly implemented and designed Section 179 strategy to reduce income, W-2 income, and Roth conversion income and other forms of ordinary income down to 0. Again, the limit is $1.2 million. So if you've got $1 million of taxable income and you're looking at a $400,000 tax bill, we can take that down to 0 with a legally designed and properly implemented Section 179 plan. If you'd like to learn more information, make sure you like and subscribe the video and click on the link below. Get on my calendar, speak to a member of my staff. We'll be happy to create a personalized Roth conversion plan analysis for you, or a tax saving analysis of the before and after benefits of what these savings will mean for you individually. Again, if you're in the 40% tax bracket, for every $100,000 of monies that you spend, you'll save anywhere from $140,000 to $150,000 of monies in taxes. What can you do with that $40,000 or $50,000 in tax savings? Well, we have folks that do this year after year after year, and those tax savings add up, and they can invest the difference. How much money will you save in general on a properly designed Section 179 plan? Well, the limit for Section 179 deduction expenses is $1.2 million for 2024. So if you've got $1.2 million of income, whether that's W-2 income or Roth conversion income, and you're looking at a $400,000 or maybe a $500,000 tax bill, that entire amount can be written off using a Section 179 expense. For every $100,000 of monies that you purchase one of these 179 eligible assets, a tiny home, you'll save about $145,000 to $150,000 of monies in taxes. So if you purchase 3 of these and you wipe out your entire $1 million of income, you'll net about $85,000 of monies in savings. Those savings can then be invested for your benefit in whatever investments you choose. And what's the future value of that? 5, 10, 15 years down the road? What if you're making $1 million of income each year for the next 3 or 4 or 5 years? You can use this strategy year over year over year, and people do that every year to reduce their taxable income.